So that is November 2019, question 1C. Yeah.
Yes.
So Sharon and Primus are partners running a hardware business. They have approached you to assist them prepare the partnership returns for the year ended 31st December 2018. The following information has been presented to you. So you have the information there. The partnership agreement provides that profits and losses will be shared in the ratio of 3:1, respectively. 3:1 for Sharon and Primus, respectively. Partners will be allowed to withdraw up to 100,000 in cash without being charged interest. Any excess withdrawals will be subject to interest at the rate of 8%. No problem. Each partner will be entitled to a monthly salary of 60,000 per month. However, no salary will be paid to any partner in the months of January, May, and September due to expected low sales based on analysis of past trends. Partners will be entitled to a commission. So can we just say that the partners will earn salary for 9 months?
Yes.
I can simply say that the partners will earn salary for 9 months. Then the balances in the books of account as at 31st December 2018 and 31st December 2017 included the following. Be very careful on the years, the arrangement of the years. They've started in 2018 and the 2017 is on the other end. In most cases, we always start with the beginning of the year, then we finish with the end of the year, but this time around the examiner interchanged. So careful, opening balances, closing balances, right?
Yeah.
They have the accrued commission due to partners. Accrued commission due to partners, you have it there. Accruals at the beginning, do we less or we add? To be confirmed. But accruals at the beginning, we less?
Yeah, at the beginning we subtract, at the end we add, right?
Thank you. Yes. Because at the beginning, that means I closed the previous year with the liability for last year. So whatever I'm paying this year is just a top up. Whatever I'm paying this year is offsetting an expense for last year, which you have to less. And accrual at the end, that means I'm closing the year without paying an expense for this year. So I add.
Yeah.
So accounts payable, accrued advertising expense, prepaid royalty income, account receivables, accrued salaries and wages, partners excluded, accumulated depreciation, no problem. Then extracts of cash payments during the year were as follows. Commission paid to partners equally. Purchases, goods for sale, those are the payments. Advertising expense, salaries and wages, motor vehicle expense, salaries and wages, are they allowable?
Yes, allowable.
Advertising, is it allowable?
Yes.
Motor vehicle expenses?
Disallowable.
It has to be allowable. Electricity, is it allowable?
Yes.
Office partitions?
Disallowable.
Thank you. WTA at what rate?
10.
Thank you. Effective 2020, that is 10%. Purchase of office equipment?
Allowable.
Office
10.
equipment? WTA is allowable 10%.
Yes.
Meals to employees?
Allowable.
Loan interest?
Allowable.
Cash withdrawn by partners? Disallowable. Cash drawings don't appear anywhere in the income statement anyway.
Okay.
Then all receipts were channeled through the account and included the following. Sales all were on credit. So it will affect our debtors control account. Royalty income, that one other incomes. Proceeds from sale of office equipment. We are not in the business of buying and selling equipment. Computer
Okay.
listing charges.
Other
That should be
income.
incomes. Yeah.
Mm.
So we are leasing out our computer to somebody else. We shall put it under other incomes.
Yeah.
The partner who hardware goods for personal use as indicated below. So drawings of goods has an effect on the cost of sales. Drawings of goods has affected our closing stock, right?
Yes.
In December, some of the hardware goods which were valued at 60,000 were destroyed by fire, and compensation of that 5,000 was received from the insurance company. Insurance compensation on stock, the taxable income, right?
Okay.
Yeah, that's an insurance compensation on revenue item. Stock is a revenue item. Insurance compensation on capital items, that is what is non-taxable.
Okay.
And fixed assets. The taxable profit or loss schedule showing, ignore opening and closing inventory. So we start with our workings.
Yeah.
Start with our workings. So we can start with the debtors control account. So debtors control account. We have the balance brought down.
Yes. 1.7 million.
The balance brought down is how much?
1.7.
So 1.7, thank you. Account receivables, you're saying 1.7. 1,700. Then on the other side, we have balance carried down.
Yes. So of 5,900.
5,900, ndio.
Yeah.
So 5,900. Transactions during the year, we have the receipts.
Mhm. Yes.
Note number 4 is giving us the receipts. So receipts, we debit the bank, we credit this account.
Yeah.
Receipts za ngapi?
1.6.
1.6. So receipts in 1,600. Any other thing affecting our debtors? Bad debts hakuna, si ndio?
Mm.
There are no bad debts.
Hakuna.
So how much is our credit sales? That's the balancing figure.
5,800.
How much?
58.
5,800.
Yeah.
So having 5,800 there. And that. I hope the account in a makes sense.
Yeah. Yeah.
So the total sales equals cash plus credit sales. So cash sales is 0.
Yeah.
And the credit sales is
58.
so credit sales we have 5,900, isn't it?
Not 58.
Or 5,800.
Yeah.
So having 5,800.
Yeah.
Then number 2, you have a payables control account.
Yes.
On the payables control account, you have the shillings. You have the shillings. You have the balance carried balance brought down.
Uh, 1600.
So there was an error there, I said 1,600. And the balance carried down.
2000.
Balance carried down is 2,000. Transactions during the year.
Hakuna.
So the extracts of cash payments, these ones are about cash payments. So meaning there's no information about credit payments. The balancing figure becomes the credit purchases. Credit purchases, what is the balancing figure?
400.
400. 400. So therefore, total purchases equals cash plus credit purchases. Cash plus credit purchases. So our cash purchases, based on the information that we have, we are having cash purchases of
1,000. 1 million. 1,000.
So having 1,000, then we add the credit purchases of 400, right?
Yes.
So our total purchases becomes
1,400.
1,400. 1,400, ndio. Sawa mpaka hapo?
Yes.
Then working number 3, cost of sales equals opening stock plus purchases minus what?
Closing stock.
Closing stock. So our opening stock wametuambia to ignore, kwa hivyo ni 0. Our purchases.
Question.
Huh?
Assuming they had given us the opening stock alafu watuambie ignore, we would have still ignored it.
Yes.
Okay.
We follow instructions.
Okay.
Then you're supposed to less the closing stock. As far as the closing stock is concerned, we're supposed to ignore it because it's 0. But on the closing stock, we add back the drawings of goods. How much were the drawings of goods? In note number 5, 110 and 60.
Yeah, 60 and 110, yeah.
So 110 and 60. The cost of the closing stock. The closing stock affected our. So therefore, we have 170, right?
Yes.
170. So therefore, cost of sales ikuwe ngapi?
1230.
1230. So you have it there, no problem. Hi. Now, with that one in mind, we can start preparing our income statement now. They're called Sharon and Primus. Let me put it here. Sharon and Primus. Uh, 2018 taxable income computation. Taxable income computation, can have that in thousands of shillings. And we have this one also in thousands of shillings. Now, we have our sales. Can we start with the sales?
Yeah.
Sales, we got a figure of how much? 5,800, right?
Yes.
So sales equals to 5,800, isn't it? Right?
Yes.
You remember the cost of sales?
Yeah, 1230.
The cost of sales, so this equals to negative of this. And we get the gross profit, right?
Yeah.
So gross profit equals to auto sum.
4570.
Then at that point, we less what?
Allowable expenses.
Allowable expenses. Thank you. Allowable expenses. Now, we'll go one step at a time. We'll go one step at a time. So accrued commission to partners, there should be no transaction between the partners and the partnership. Accounts payable, we've dealt with it. Accrued advertising expense. So let's have advertising expense. Advertising. Remember our principle. How much was paid during the year? The amount paid during the year is 150. Right? Right?
150. No.
Oh, you 150 advertising expenses.
Oh yeah, yeah. Oh yeah. Okay. Yes.
So during the year we paid 150.
Yes.
As we are starting there, do you have a prepayment or an accrual?
An accrual.
An accrual of 340.
Yes.
And the accrual at the beginning we add or we less?
Less.
So we less 340. And at the end of the day, we had an accrual or a prepayment. An accrual of how much?
An accrual of 610.
Of 610.
Yeah.
So how much is the advertising expense for the year?
For 20.
How much?
420.
420.
Yeah.
So that is advertising. Prepaid royalties will come later. Receivables, we've taken care of them. Salaries and wages, that is an expense. How much did we pay? We paid 1390.
Yes.
They have salaries. Salaries and wages. So during there we pay 13 ngapi?
1390.
We pay 1390. Tukianza mwaka was a prepayment or an accrual?
Accrual of 130.
Accrual at the beginning of 130. Do we less?
We less.
And we add accrual of how much at the end?
410.
410. So how much are the salaries for the year?
1670.
Sorry?
1670.
1670. So you have that one there. Then after the salaries, depreciation is noise, extracts of cash payments, commission to partners will come later, purchases will be taken care of that, advertising is sorted, salaries is sorted, motor vehicle expenses, can you allow those ones?
Yes.
So motor vehicle expenses, an amount of how much?
240.
240, right?
Yeah.
Electricity, is it allowable?
Yes.
Electricity is allowable. How much do you have?
80.
So you allow the 80. Office partitions, we have the WTA.
Yeah. WTA of 10%.
So WTA on partitions, you're having 10%. So 10% of how much?
60.
Of 60.
Yeah.
10% of 60, right?
Yeah.
That is 6. Office equipment, still WTA.
10%.
Remember, it's not office electronic. It is not office electronic. For it to be 25%, it has to be electronic equipment. So this one is still 10%. 10% of 97. Which is how much? 9.7.
9.7.
Meals to employees, are they allowable?
Yes.
How much are the meals?
200.
200. Loan interest.
Yes. 35.
Loan interest is 35. So cash drawings, that one is later. Sales, you've taken care of them. Royalties are there. Wow, there's something that we didn't add here. There's something that we didn't add here. After the gross income, there's this insurance compensation. Kindly, let's find a way of squeezing it somewhere there. Sorry for that. So we add insurance compensation on stock. Remember that one?
Yeah.
Insurance compensation for stock. The insurance company compensated 35. Yeah.
Yes.
We add there the 35. I think that is it. So what are the total?
2660.7 for the expenses.
9660.7.
7.
So 9660.7, that's okay. Wow, watch it. So 9660.7, so that the taxable income, taxable business income,
1945.3.
1945.3.
Yeah.
That is our taxable business income.
Yeah. No, 1944. Sorry.
1944.3.
Yeah.
Okay.
Good. So there we go.
Yes.
So can you take care of the allocation schedule?
Yes.
Allocation schedule. We have one partner known as Sharon.
Yeah.
We are having Sharon. And you are having Primus. And you have their total. And you have their total. So can we start by giving them the salary?
Yes.
So salary to partners. Each partner was earning 60,000. But 60,000 for the 9 months, right?
Yeah.
So having 60 times 9.
540.
How much?
540 for each.
540.
Yes.
So 540 for Sharon, 540 for Primus, and the total is 10.
1080.
1080. Sorry, not here. So 1080. Do you have interest on capital? So the partners will be allowed to withdraw up to this much. We had the commission to partners. As far as the commission is concerned, how much commission was paid during the year?
400,000.
100,000. At the beginning, we had an accrual of this and accrual of that. Can you take care of that?
Yeah.
So during the year, we paid commission of 100.
Oh yeah, 100.
We subtract the commission, the accrued commission at the beginning of 360, right?
360. Yeah.
Then we add
And then
the accrued
400.
commission at the end of
Yeah.
400.
Yeah.
So how much was the commission for the year? The total commission?
140.
140.
Yeah.
We are told that they shared equally. So it's 70. And we don't have the interest on capital. We don't have the interest on capital. It's not there. We have the interest on drawings.
Yes.
We have the interest on drawings. Let's have a working on that part of working for that part of ours for workings. So we need a working number 4, interest on drawings. Interest on drawings. So we can have here, we can start with Sharon. Sharon. Now, as far as Sharon is concerned, we are told that the partners will be allowed. The partners will be allowed to withdraw up to 100,000 in cash without being charged interest in cash, not goods. So the cash drawings of Sharon was 160,000, and the goods drawings were 110. So therefore, any extra amount was charging interest at 8%. So for Sharon, we start with the 160, we remove the 100, which is exempted, then we add the 110, right?
Yeah.
So here we have 160 minus 100. Then we add the drawings of goods were worth 110.
Yes.
And we charge it interest of 8%. How much is that?
13.6.
So 160 minus, we are left with 60. 60 plus 110 is 170. 8% of 170?
13.6.
13.6. Then Primus, the cash drawings of Primus were of 100,000. So meaning all the cash drawings will not attract any interest, but the drawings of goods are 60, right?
Yeah.
So you can use the same one, 100 minus 100 plus 60. And that is what we multiply by 8%.
4.8.
4.8. 4.8. So therefore here for Sharon we are lessing, so it's negative 13.6. And for Primus is negative 4.8. And the total interest on drawings becomes what?
18.4.
18.4.
Yeah.
18.2?
4.
18.4, sorry. So therefore, we have the taxable business income. The total income from the business was this one. So out of this, what will be the share? Share of profit. Share of profit or loss as the balancing figure. So this one equals to, we take this, we subtract this, we also subtract this, we also subtract this. Is it? Let's just confirm the summation of these ones.
Yes.
Yeah, that is correct. Because the total of these four should be these.
Yeah.
So this one, I think we are not badly off. Then I can bring in other incomes. Other incomes, we have the royalties. The royalties, how much did we receive during the year?
240.
We received royalties of 240.
Yeah.
At the beginning of the year, we had prepayments or accruals.
Prepayments.
The prepayment at the beginning is 100. We add.
Add. Yeah.
We add prepayments at the beginning of 100. And we less the prepayments at the end of how much?
160.
160. So the total royalties for the year?
180.
180.
Yeah.
So total we have 180. Share based on that profit and loss sharing ratio. Are they sharing profits and losses? 2:1. Sharon gets
120 and 60.
so this one gets 2, this one gets 1.
Yeah.
So total is 3. So 180 times 2 over 3,
120.
120. And this other one is 60.
Yeah.
Do you have any other income again? We had computer leasing
Computer.
charges.
Yeah.
So computer leasing charges, the total was 6,000.
Yeah.
It's here 6,000. So total is 6. 6 times 6 divided by 3 is 2. So this one is 2.
Yeah.
This is 4.
Yeah.
So do we have our total taxable income? We didn't add this.
Hmm?
We didn't share this one.
For Sharon is
We didn't share
4.
the profit. Can you share the profit?
Yeah. For Sharon,
Yeah.
493.13.
493.
Yeah.
493.13.
And for the other one is 247.56.
247.56.
Hmm.
So we have the summation. So there we go. Sasa tumemaliza.
Yeah.
That is it with that question on partnership.
Yes.
Hmm.
Thank you.
Let me